Hey everybody, so we move into activity 10. This is CGT calculation 2, chapter 15, and this particular one concerns BADR, okay? You know what I've said about reliefs, you know what I think about them. I'm not going to repeat myself in this particular case, but this BADR is possibly the most complex relief because it can interact and link with other reliefs. In this particular case, in this particular question, it's not doing that. The examiner is really sort of focusing in on another key area, which I'll explain in a moment. But let's be familiar with the relationship between BADR, business asset disposal relief, and indeed other reliefs, e.g. gift relief. Okay? So let's take a look at the requirements. It basically just says, calculate Nigel's CGT liability. I'm none the wiser. I don't know what's up top. In terms of the scenario, I would have thought that if there's a CGT liability, again, as I've said elsewhere, there's going to be some easy marks and there's going to be some difficult marks. Let's make sure we get the easy marks, application of rates to non-business assets, deduction of the AE, etc., etc. Okay, so what's the scenario in relation to this gentleman, Nigel? So looks like he's the owner of a business. He set it up in 2012, and then in our tax year, the business ceased trading. Okay. Now, it looks like after the cessation, within a fairly short time frame, 30th September 2023, he sold the freehold premises. So in other words, he sold an asset of this business, okay? For $750, it had cost $300. Immediately I'm thinking, okay, well, one way or another, I'm calculating the gain on that, okay? And maybe I don't know how to use it or how to use BADR, but there's some easy marks, half and half for the proceeds, half for the cost. So far, again, obviously I was prompted by the area. It looks like we have an individual who's selling a business asset. And indeed, we know from our BADR knowledge, I hope, that where a business ceases, and indeed it sells either the business or an asset of that business, BADR could be in play subject to conditions. Now, outside of that, they give us details on something completely different, i.e. the disposal of quoted shares in an investment company, realizing a chargeable gain of 15. So nice enough that the examiner actually gives us the gain. Okay. Outside of that, they tell us no previous disposals, relevant to BADR. Now we know that one of the key points in relation to BADR is that 1 million lifetime limit. Okay. So none of that is used up. Okay. So outside of that, final point, obviously the examiner has to give us details on income, either total income or taxable income, in order for us to be able to calculate CGT. And in this particular case, note, this is taxable income. It's not total income, it's taxable income. So the PA has been deducted, 30,000. Now, I think what we're going to have to do, and I'll explain a little bit more in detail in a moment, is we're going to have to compare this 30,000 to the basic rate band. Think of why we have to do that, in what sense, and what comes out at the end. Okay, so in summary, we've got what I think, is a qualifying disposal, in effect. And this particular asset, is quite easy to deal with on the face of it, i.e. the gain. But where we need to go from there is, okay, well, what rate are we going to apply to the gain? And do we simply just lump in or include this 15,000, at the same rate, or would it be a different rate? Now, there's a bad word in tax, It's a bad word, like a curse word, and that's it, investment, Generally speaking, where you see that word, there's going to be an issue, particularly when we're talking about income or gains, okay? Now, in terms of the answer, a calculation is required. I'm going to start at the beginning, score some easy marks, and then go from there. I think what I've got to be careful about is the point that I've just made. In other words, I know that BADR qualifying assets attract that low rate, don't they? That 10%. But I'm just wondering, what would this attract? What would this 15,000 attract? I think that's the crux of this question, okay? And what we'll see is the correct approach is to use separate columns, okay? Now, in terms of the answer, I'll just go down this slowly. So what we see is answers set up, and note immediately several columns. One, eligible gains, i.e. eligible for BADR, and two, other gains. Now this is typical of the TX examiner, where he throws in another asset, hoping that what you'll do is just lump all the gains together. And in this particular case, we know that we don't, because the bottom line is that this other gain isn't eligible for BADR. So what do we have here? We've got 450, more of that in a moment.